coronavirus and the Fed. A lot of stuff that we don't know how it's going to pan out.
Yep.
It's also Super Tuesday.
Yeah.
Not really talking about that. And we've got a Biden surge that's happening. How much is what the action we're seeing today suggesting that the president's trope about the downdraft relating to Bernie Sanders, does this kind of obliterate that line of thinking? How much should we be thinking about the results we see tonight as affecting the markets tomorrow and for the rest of the week?
I think right now the focus is on Corona. I actually think the election or today's Super Tuesday is more of a secondary item, though it certainly is very important, okay?
Even if Bernie does well.
Well, if Bernie does well, it's still about Corona, and you've got to remember that Bernie would be then running, if it would be more likely to be running versus Trump, but you still have the Democratic convention to go on. So I would see tonight, I want to be watching what happens tonight on the screen as it develops. But my real play here is I'm waiting for somebody to come up with an immunization that has a good chance to get approved, that can make an effort, and just greater efficacy in dealing with those who fall ill and containing this thing. Related to sectors, I can't help but jump in here. We continue to like cyclicals. We think the defensive stuff is overpriced at this level. Bonds are ridiculously priced right now, especially when you anticipate when we get beyond this. And remember what happened in China. The growth rate in terms of the increases in illness is starting to roll over. That will happen here and outside of the world, particularly in the developed and the more advanced emerging market nations.
Okay.
We can look towards that.
All right, gentlemen, thanks for joining us. John and Ben.
Thanks.
Thank you.
Let's get back to our Eamon Javers to the White House for reaction. Eamon on the North Lawn there. What should we be thinking about from the Trump administration's perspective with this rate cut, which the president was calling for, and also the political winds that are blowing?
Look, one interesting piece of color here, John. Officials won't say that the president watched that press conference that we saw from Jay Powell just now. They're not sure that they can confirm that. But the president was scheduled to leave the White House for an event across town. They were scheduled to leave at about 10:45 in the motorcade. That motorcade held with everybody loaded and ready to go in the motorcade, you know, engines idling and all of that, until 11:13 a.m. when the president emerged from the White House, jumped in there, and off they went. What else happened at 11:13 a.m.? Jay Powell finished up his news conference. So at that same moment, the president emerged from the White House and jumped in the motorcade, and off they went. So they're not saying for sure that he watched this presser this morning, but something kept the president for exactly the same amount of time as the press conference lasted today. So White House officials do tell me the president is paying very close attention to what the Fed is doing here, John.
Eamon, thanks for that. Seems like we'll talk to you again in like 15 minutes or so. Our Eamon Javers of the White House. We do want to watch yields, 10-year 102 and change, which is a record low. Rick Santelli's in Chicago. Hey, Rick.
Hi, Carl. You know, as I look up at the board, I want the viewers to be with me here. So we settled 10s yesterday at 116. It broke a 7-day streak of lower yields. The Dow was up, what, 5+%. And when the announcement came about a 50 basis point cut, we're at 113 down 3. Now we're at 102, so we're down 11 from where we were, and obviously we're down a boatload from the 116 we closed. I just don't see the point. Listen, how do we know if the Fed did the right thing? Well, to be fair, we need to see where the markets close. But if we evaluate them real time, marked to the current market, I don't know. I think John said it best. Vol. Why would you welcome vol? The correlation's so clear. Everybody on this floor understands vol goes up, positions get smaller. Vol go down, positions get bigger. Well, vol went down yesterday across the board. TY VIX, the actual VIX. Obviously, this announcement would kick up vol. If they were true market aficionados, they would have waited for the algos to close and the vol markets to close. The algos jumped in, maybe do it on an evening or a Sunday night. Listen, it just doesn't make sense. And the other issue, Carl, is anybody out there ever heard of this weird old school term called tough love? Do you always give the kids everything they want? And I'm hearing they're going to maybe take it back, okay? Let me see. You give your kid an ice cream cone with 2 scoops. He eats 1 scoop, and all of a sudden you take it away. Give me a break. They're never going to be able to take it back unless the economy zooms, and we can only hope. And I guess the final analysis, whether this is a good idea or not, is that everybody defending it's talking about fiscal Fiscal stimulus needed. Well, let's look at that. Why haven't we done any fiscal stimulus? Well, probably because Congress was in impeachment mode forever, and you can't be building bridges if people may get infected. Let me think. Have I missed anything? Morgan, back to you.
Rick Santelli, thank you. Robinhood, meantime, is down again. Kate Rooney has that story from One Market. Kate.
Hey, Morgan, Robinhood's seen its second day of major outages, leaving clients unable to trade these market swings. The technical issues started Monday morning and through the close yesterday. Equities, crypto, and options trading all down right now, as well as email support. Robinhood was last valued at $7.8 billion. The company late last night saying they were up and running, but by this morning tweeting they're still experiencing downtime. Users are not holding back on Twitter and Reddit. Some very colorful commentary and complaints. Many of its 10 million users claiming they plan to leave the platform, others threatening a class action lawsuit. I spoke to one user stuck in a short position against the S&P. He's watching as those losses, quote, balloon. The legal implications are unclear at this point. Robinhood users' agreement is 44 pages. I have it right here, guys. There's a line here on page 15 that says, Robinhood does not warrant that these channels will be available and error-free every minute of the day. Some legal analysts tell me FINRA and the SEC require Robinhood to have a backup plan in the event of a natural disaster or an outage like this. A former SEC official also telling me that this raises red flags for regulators. The SEC, though, declining to comment. Guys?
Yeah, that's a risky position to be in if you're a platform named after a vigilante. Kate, thank you. Bob Pisani and Mike Santoli join us now here at Post 9. Lots of market action to talk about, guys. Bob, I mean, first of all, that Robinhood thing.
Yeah.
Come on.
Well, the second day of outage is a problem, but we're going to have Brett Redford on from the SEC talking about it. The U.S. market system, the structure itself has held up very well. I think he's going to give us an update, hopefully in the next couple minutes. But what's amazing to me today is we've had 2 votes by investors on the SEC's announcement today. We had the initial vote by everyone who said, oh, yeah, SEC getting ahead of the curve. That's a great, the Fed getting ahead of the curve. That's a great idea initially. Market moved up. Then we had the other crowd coming in a little after that saying, you know, this looks like they wasted bullets needlessly or that they're showing excessive concern and panic. So we saw some consumer names move up initially on this. So Home Depot and Nike moved up. But a lot of stuff that would have been affected by the global economy and by the coronavirus never moved. Industrials never moved. Banks never moved. The travel stocks never moved. So right now, the crowd that's saying they wasted their bullets is winning. But stick around another hour. Maybe that'll change.
But you know, it did move. Rates. We saw rates initially go higher. Now they're lower, right? Fresh record low for the 10-year right now. Is that part of what's pulling markets down as we speak?
Yeah, I think so. I mean, I think a general reaction was, okay, we can put this in the books. Now it's very difficult to see if we're prepared for whatever the news flow is right now. Yet, you know, it's really interesting because on the one side, you have the criticism that they're wasting ammunition without really knowing what they're shooting at. On the other side is they must know something's really bad and they're rushing to catch up to it. So I think that the lack of clarity just about the economic pace right now and the likely impact of all these measures being taken is what's weighing on the markets. You know what else is weighing on the markets? In fact, it was up 4.5% yesterday. And that's a very kind of agitated market. It's very twitchy. And when you have one of these big rebounds off of a very sharp correction, it's just a little bit fragile. And
This was what got said after our first 3% move, is that they tend not to come in singles or doubles, right? Once they start, they tend to come in big clusters.
Yeah. But if you look here, what the market's saying, like look at Exxon. So a rate cut you would think would try to stimulate demand in some way, and certainly that might help, say, consumption and certainly demand for gasoline, for example. So you would think Exxon might move a little bit on that. There was no reaction at all in any of the energy stocks. There was no reaction in the industrials, but I think it's more important to watch the energy stocks there because you implicitly think this would have a demand difference, and the market is sort of saying it's not going to have that much impact. That I think is a very interesting way to look at it. Industrials, you can argue, well, okay, it's not going to solve the problem. They're still going to see demand reduction because of coronavirus, but you think there'd be some stimulus effect on energy stocks from the Fed, and they're not moving right now.
I mean, look, we've traded from, you know, what, 33.90 at the highs down to 28.55. That's your range of things are perfect to we're really scared we're back to where we were last summer. You're kind of knocking around in the middle of that, not being sure what to make of the latest move in the bond market and all the rest of it. So it's very hard to extrapolate from here and to infer a very clear message from what the market's struggling with right now, except to say that maybe it does seem like it was a little bit clumsy timing and in terms of the Fed rate cut.
Because we were only down from the highest levels in the history of the world.
Well, no, I mean really more short-term tactically, right? You didn't do it Friday. People thought you'd do it over the weekend. You didn't do it over the weekend. Then it was maybe yesterday's rally meant you didn't have to do it. And so I think the static in that message maybe is a secondary factor here. But I don't know. It's very hard to necessarily say here is exactly what the market's upset with.
So now I got to ask again about Super Tuesday, because can't forget, it is Super Tuesday. We've been talking for weeks, if not months, about how much clarity there's going to be politically after we see not just who wins, but by how much. How much of a reaction for the rest of the week, Mike, should we expect based on, I don't know at this point whether a Bernie Sanders win the market likes because they think Trump can beat him, or a Joe Biden win the market likes because I don't know.
Because the most market unfriendly options off the table, right? Exactly. It's completely hard to tease that apart. Yesterday's rally was an amazing Rorschach test because you had people say it was moderates consolidating behind Biden. That was part of what the rally was, right? And literally, I had people telling me that at the end of the day, and then you had other folks saying it's expectations of what's going on with the Fed, or it's just we had mega oversold conditions and the rubber band was pulled so tight that it snapped back.
I think it's really hard to tease tease all of this out. What I see, what you just watch the market, stop having your own opinion, just watch. The market moved on the Fed here today. So obviously the market's making some kind of bet on whether this is the right timing or bad timing or not going to be effective or not. And the market moved as soon as coronavirus headlines got really serious. It's hard for me to say, aha, the market moved, when Sanders won in Vermont dramatically, we could see an upswing. I can point it to you on coronavirus. I can point it to you on the Fed. It's really diffuse when you start dealing with the political issues. I think that's the only fair way to talk about it.
Meanwhile, the president's talking to the National Association of Counties today, their legislative conference. He did say he would be going to Tennessee on Friday in the wake of those deadly tornadoes. It's an incredibly busy week for the president on that front. And he talked about the Fed move. Take a listen.
Do it more. Do it a little bit more. You want to be competitive with these other countries. Other countries have lower rates because their feds, their currencies are cut to a level and their rate is cut. They play with their currency. They play with the value of their currencies, and we don't do that. We don't do that. We have a different kind of a theory going, and it really puts us at, and I don't say necessarily to do it, but we have to be competitive with other countries. When we're paying 2 points more than Germany, or we're paying more than other countries, we should be paying less than everybody else. We have the dollar. We have the strength. We have the greatest country on earth. We should be paying less. So the Fed rate is too high. It's very simple. It's too high. It puts us at a competitive disadvantage, especially when it comes to exporting our product to other countries. The other countries love that. I don't like it at all. So I'd like to see our Fed lead instead of being led. We have created...
All right, so not a single mention of the coronavirus in the context of that statement. You could have run that soundbite a year ago. It would have, you would have thought it was that.
And it's probably going to remain a very steady message from that side. Now, look, the dollar's down.
Well, is he using the virus as an excuse in this case?
It seems to me even before the virus, I think he wanted zero or negative, right? I mean, just this, whether the president wants it or the president feels like it works to just say, look, this economy could be run hotter under other terms. That seems to be what the message is. But again, on this rate cut today, the dollar has come down. And if you talk to people in the currency market, they say because we have room to further ease, we still have positive rates. That actually creates downside possibility for the dollar, if that's really what you're worried about.
Wow. Still a long day ahead. Bob, Mike, thank you.
Okay.
All right, let's get over to Diana Olick, who has a check on rates and how the Fed's move is hitting the big home builders right now. Diana.
Yeah, Morgan, stocks of the big builders jumped on the rate cut, and they're still holding mostly in the green. The home building ETF is off the session high, but up over 1% and up about 5% week to date. It's on pace for its best week since June 7th and out of correction territory, being led by names like Lennar, Pulte, D.R. Horton, all up more than the broader averages. Mortgage rates don't follow the Fed funds rate. They loosely follow the yield on the 10-year Treasury. Still, the drop by the central bank is a result of high volatility in the markets and concern that the coronavirus will impact the economy. That will keep investors in the bond market. We're seeing yields lower, hence driving everything in the mortgage world lower. Now, the average rate on the 30-year fixed hit 3.13% on Monday, matching its record low, according to Mortgage News Daily. Mortgage refis are surging on the news, but there are big question marks for the spring housing market. Buyers could pull back if they're worried about the market and their jobs. And one thing to note, the S&P real estate sector is in the green. That's made up of REITs, and REITs, of course, are a low-yield play. Back to you guys.
Diana Olick, thank you. Also with us now for his take on the market reaction is President and Chief Investment Strategist of Yardeni Research, Ed Yardeni. Ed, thanks for joining us by the phone right now. Want to get your reaction both to this cut by the Fed today and also the pretty wild swings we're seeing in the stock market in response.
Absolutely. I don't think anybody is really surprised by what the Fed did. It would have been very disappointing if they did 25 basis points. I would not even have been surprised if they did 100 basis points. So, as a matter of fact, I wrote that up on Monday, so I was half right. We got the 50 basis point cut. But this is all signaled by Jerome Powell on Friday when he issued a statement saying that the Fed would do whatever is necessary to help the economy overcome the coronavirus. And the bond market's been anticipating that the Fed would do exactly what they've done. So there's kind of still on the news going on here, a little bit of a recognition that there's really nothing the Fed can do to cure us of this virus plague that seems to be spreading around the world. And I think it's getting to the point where a lot of us have come to conclude that enough already. I mean, the Fed can't fix everything, and by trying to convey that Fed policy can do that, it's disconcerting.
Ed, I wish we had more time today. Appreciate that very much for coming to the phone. Ed Yardeni, we'll talk to you soon. The sell-off here, obviously, still in place. Dow's down 422. The Fed's rate cut got some support, though, from former Council of Economic Advisors Chair Jason Furman, who tweeted, "This was a bold and correct move by the Fed. You should judge its success not by the stock market, but the bond market, and the interest rate on the 10-year note is down about 6 basis points to 110. Of course, it's since moved to south of 103. Jason Furman joins us on the phone. Jason, good to talk to you as well.
Good to be here.
You still feel good about this?
I mean, I don't think there's a whole lot the Fed can do, but this is certainly on the plus side of the ledger, what they did today. They surprised on the upside. That's why you're seeing a weaker dollar. That's why you're seeing interest rates down. Those are the things that matter the most in the economy. They can't stop a recession if supply chains completely freeze up, but they can, do what they can do, and that's what they've done today, and indicated they'll continue to do if they need to.
Yeah, he even said cuts will not reduce the rate of infection. It won't fix a broken supply chain. What do you think happened between a Powell statement on Friday and 10 o'clock this morning? Was it a sense that fiscal policy was going to be stubborn to come to fruition? Yep. Was he briefed by some health officials? What do you think happened?
We're just learning more every day. I was never worried about supply chain disruptions in China bringing down the U.S. economy. It's when the virus comes to the United States that you have to worry, and the amount of community transmission that we've been seeing in Washington and Rhode Island and New York, around the country, is just growing, and this is exponential. That's the way something like this works, and each day we're learning more. So could he have acted on Friday? Sure. Does it matter that he took 2 extra days? Not at all.
Jason, I want to get your thoughts on, given the fact that we are seeing these massive swings in the market, if you are you know, somebody who is not day trading, not paying attention to the market every day, but is invested in the market, you're tuning in now, you're seeing this. Do cuts by the Fed actually help to quell your fears and help, I guess, support or sustain household confidence when you're seeing 700-plus moves in the Dow in the course of a couple of minutes?
Yeah, I think this is less about confidence and more about, you know, the actual, you know, what the interest rate is, what the value of the dollar is, what that will mean for, you know, American exports, for, you know, borrowing in America, mortgages, and the like. I think confidence here, you know, matters too. It's just, you know, it's hard. You know, 24 hours from now, people are going to forget this move by the Fed and just be focused on, you know, whatever the latest case of coronavirus that they're hearing about is. So the confidence of this only lasts so long. You know, in terms of most investors, you know, I would just sleep easy, try not to watch CNBC, and check what's happening to your stocks on any given day. I'm just kidding. Of course, watch CNBC. Just don't trade every minute based on it for most investors.
We're okay with that. We're okay with that. More information is better than none. Jason, thank you again. We'll talk to you soon. Jason Furman. Bob Pisani's here at Post 9 with SEC Director of Trading and Markets, Brett Redfern. Bob.
Thanks very much, Carl. This crazy market volatility has put unprecedented stress on the U.S. trading system. Friday saw the largest dollar volume trading for U.S. equities in history. $986 billion changed hands. That's according to Goldman Sachs. That's nearly 3 times normal levels. So that kind of trading volume catches the attention of the SEC. Joined now by Brett Redfern, Director of the Division of Trading and Markets for the SEC. He's been monitoring all these record trading volumes to make sure the system is still running smoothly. Brett, thanks for joining us. What is the verdict? How is the U.S. trading system holding up?
I'll tell you, Bob, we've been seeing some pretty extraordinary market activity. You mentioned the high volume that we saw on Friday. I think one thing we look at very closely is the message traffic that you see in the market. In some cases, we've seen message traffic actually doubling. And I will tell you, our markets have held up very well. They've been orderly, they're functioning well, and you know, we've seen very few technical issues, very few system glitches, and fundamentally, I think the verdict is our markets are demonstrating remarkable integrity and resiliency.
Well, that's certainly good news, but I guess why? We've had issues in the past. We had systems come down. Is there something new the SEC is doing or the exchanges are doing to have more robust connectivity, less issues?
It's a good question, and you know, I think we all remember times in the past when we saw more outages and glitches and things like that happening, and it's pretty impressive that we're not seeing that right now. I think the exchanges have made a significant amount of investment in the infrastructure, and I would also say the SEC's put a number of different rules and other procedures in place. For example, one is called Reg SEI. It stands for Systems Compliance and Integrity. Reg SEI says you have to have backup systems, you have to test your systems, you have to make sure your systems are resilient and are capable of handling a lot of message traffic like this. So I think those things are helping.
Okay. And Brett, you are in regular touch with other government agencies. I know you meet with them regularly to discuss about market traffic and what's going on with the Fed and with some other government agencies that are out there with Treasury. Can you characterize your meetings in the last week with them? What have you been discussing and what have they been telling you?
I think it's important to point out that we do talk on a frequent basis. We talk to the Fed, we talk to Treasury, we talk to other regulators of financial markets like the CFTC. I would say that those meetings have definitely picked up in the last week because, you know, we're seeing a lot of things. What we try to do is we try to share observations. What are you seeing? What are the potential risks that you see? And so that kind of communication and cooperation, I think, is very helpful. And I would say that it's a very good working relationship across the official sector.
Leon Cooperman, who's a frequent guest here, was on last week, and he called for bringing back the uptick rule that went away several years ago. Have you ever looked at this? Is there a reason why we should consider bringing it back? Is there a position from the SEC? And would it do anything if we did bring it back?
So I think one thing, Bob, and I think you know this, we did put in place an alternative uptick rule. It's called Short Sale Rule 201. So we have a mechanism in place to make sure that short sellers at a certain point aren't sort of pushing the market down. So effectively, if the market's dropped by 10%, then short sellers can't actually hit bids. They have to post on the offer side of the market. That slows them down, and that's an initiative that was put in place after the financial crisis to help deal with those concerns about short sellers.
And last question, Brett. we've had very high volatility, and often traders come on, they complain about a lack of liquidity, where the market makers, the bids and offers, bids and asks tend to dry up in times of high volatility. Has the SEC ever studied this? Is this a real phenomenon? Do you believe it exists? And is there anything the SEC can do about it if it does exist?
So we look at a lot of things in the market, Bob. We're looking for, limit down halts. We're looking for, what we call self-help declarations. And we're also looking at, sort of microbursts of activity that can cause liquidity gaps in the market. And sometimes that may or may not relate to, market participants that are out there. You also know that we're talking to market participants all the time. So we're calling banks, exchanges, market makers, clearing firms, and that's part of our monitoring effort as well. So, we're not seeing market makers pull out of the market. I think the best way to characterize it is, while people might not always like the prices that they see, there's always buyers there, there's always sellers there. People who want to get something done have been able to get it done.
All right. Brett Redfern, Director of the Division of Trading and Markets for the SEC. Thanks very much for joining us. Appreciate it.
Thanks for having me, Bob.
John, pretty good, overall, pretty good grade here. Well, tremendous stress. Higher trading volumes than we ever saw in history on Friday. A very hairy open. And so far, the system's holding up very well.
Thanks so much for bringing us that. Okay. Now let's close the show out at the CME. Rick Santelli's reaction to the president's call for the Fed to follow Europe and cut more. Rick?
Yeah, I'll tell you what. Fed was talking about this, the greenback, the dollar. And he is unhappy with the dollar's strength, which should and sometimes does correlate with our rates being higher on a relative basis than many of the negative and lower rates in Europe and Japan and elsewhere. The problem with his logic, though, is that if you're a middle-class American here in the borders of this country, the stronger this is, the more of all the imports you get to buy. You get to buy more foreign-made cars at a cheaper price, cameras, electronics, all of that is cheaper. What it's going the other way he's talking about is if this gets bigger, exports, so the big multinationals. And I'm not saying there's anything wrong with multinationals, but really it is the benefit of multinationals and those who hold their shares versus middle class and many people that are buying things. I like cheaper things real quickly. And competitive disadvantage, compare GDPs with Europe. Who wins? We win. Back to, let's see, Carl, John, and Morgan.
Rick, thank you very much. Wapner's got a big show. Lasry, Rick Ryder, Scott Minerd, El Arian. Let's get to the half.
All right, Carl, thanks so much. Another volatile day for the market with your money once again front and center. Welcome to the Halftime Report. I'm Scott Wapner. Our breaking news coverage of the markets continues right now. The committee is here to help us navigate all of this, along with a number of special guests today. Jim Lebenthal is here, along with Josh Brown. Shannon Saccocia is the Chief Investment Officer at Boston Private Wealth. Mark Lasry is the Chairman and CEO of the Avenue Capital Group. Steve Leisman, you know him. He's our Senior Economics Reporter, all over today's move from the Fed. And from New York, Rick Reeder, BlackRock CIO of Global Fixed Income, will be joined momentarily as well by Mohammed El Arian and Scott Minerd. Let's check stocks right now. And what I have said is a volatile day thus far. The Dow Jones Industrial Average right now is off by 1%. That's a loss of 280. S&P is down 0.75%. The 10-year note yield, big focus today. Yes, it's up a slight amount right now, but it was as low as 102, and we're keeping our eye on all of that. Steve, I turn to you first as we try and make sense of what happened today and this 50 basis point cut, the largest since 2008. You say it was meant to be a surprise, but you weren't surprised.
No, I don't think if you were paying attention, you should have been surprised. Let's go back to the tail of the tape. Friday, an unscheduled announcement by the Federal Reserve Chairman at 2:30 p.m. where he said that he would use all available tools and the Fed would act as appropriate. That was one. Yesterday, we got comments from Kuroda, comments from Lagarde from the ECB, comments from the IMF and the World Bank, all along the same lines. We learned about the G7 meeting. This is exactly what you would expect if you went back and looked at how these things work, Scott. There was a complaint earlier this morning in one of the headlines I read that a market sells off because G7 meeting, not enough, no policy action. Well, it was 2.5 hours later, you got the policy action.
The question is, Mark Lasry, was it the right move, or do you think, did the Fed panic?
Look, I think for me, it probably panicked a little bit. I don't know what a lower rate cut is really going to do. If you sort of look at what's going on and why markets are going down, it's because people are worried about this virus, right? So if you sort of think air travel is, people aren't traveling as much. People are canceling events. The fact that the Fed lowers the rate doesn't mean you're going to reschedule those. So at the end of the day, what you're saying is, what the Fed is saying is, we're willing to make sure there's no issues and we'll make the cost of capital cheaper. That, I think, makes sense. But at the end of the day, you've got to have people using that capital. And that, I think, is going to happen 30 days, 60 days, 90 days from now when people are less worried about what's happening with the virus.
So, Josh, Chair Powell, he spoke to that. We don't think we have all the answers, he said. This will avoid a tightening of financial conditions. It'll boost consumer and business confidence. That has to count for something, even though everything that Mark Lasry just said is correct.
I agree with everything Mark said, and I'll take it a step further, though. I actually don't think it'll boost business confidence. I think business confidence is a blip on your screen every day, and what you're looking at is the market having already given itself a rate cut. Look what Treasuries did before the Fed opened its mouth to say that they will act, and look what they're doing once they did act. So you already have a rate cut in place. It already exists because of market conditions. You could refinance a 30-year mortgage that was a 4% mortgage a year ago. You could now do a 15-year mortgage at under 3%. Why financial conditions have to get easier in that environment makes absolutely no sense in terms of combating what is sure to be weeks and weeks of negative headlines.
Why not get easier? What's the downside?
Because you cannot give it back. You cannot give it back. You understand? You can't do rate cuts. You are never raising rates in an environment like this for the foreseeable future, unless there's some massive fight with inflation, in which case we have bigger worries. So if you know you can't put the genie back in the bottle, and we all agree financial conditions are actually pretty easy right now, then what we're saying is this is to make people feel better. Okay, fine. So then do it the right way. Don't just drop it out at 10 a.m. when no one's paying attention. If you want it to have a psychological impact, then make it meaningful. Do it with some bombast. This was very ill thought out. I don't know why they felt the need to do it right this minute. We actually were not in bad shape coming into the day, and now all of a sudden people are saying, wait a minute, they did it? What's coming? Is it getting worse? What do they know about the jobs report on Friday that we don't know?
Those are all good points. Everybody's made good ones thus far. Mohamed El-Erian, so what is your reaction to what the Fed did, this 50 basis point move? Mistake or justified?
Look, they're in a no-win situation. Had they not done anything, the market would have been disappointed. The market has already priced in not just this cut, but as noted earlier, even more. But doing it doesn't actually help because, as Mark Lasry pointed out, the damage on the ground is not something that the Fed can help. So we have two problems here. One is that market expectations are running way ahead of reality in terms of what policymakers can and will do. And the second one is that the Fed has a massive communication problem. It can't, on the one hand, say that you need an emergency cut and signal that this is an emergency situation, but on the other hand, say the economy is fine and this is an insurance cut. So this is a no-win situation for policymakers, and what you really need is not the market forcing their hand. What you really need is medical progress in A, containing the spread of the virus, and B, increasing immunity and recovery rate. That is what's going to make everything consistent, not the Fed, not the G7.
But what's the harm, though, to Steve's point, Mohamed? I get the point that Josh has made. Why shoot bullets that you can never put back into the chamber? But why not do something like they just did? What's the harm?
Three things. One is that you're getting closer to the zero bound, and therefore you're taking away policy flexibility, and you do not want to go negative because that will really break things. Two is you want to keep interest rates when you see market malfunction, when you see parts of the market no longer providing proper liquidity, and keep an eye on the high yield market. That's the area of greatest risk. And three, credibility. Forward policy guidance by the Fed is a very important policy tool. So having the market set off during every press statement, press conference is not a good thing.
Yeah, Mohamed, we appreciate your time very much. We know you got to run. I'll let you go, but we do certainly appreciate hearing your voice today. Rick Rieder, you've made some points. There's a lot of leverage around the globe. The Fed has to keep rates low. Structurally, it's part of their policy. They can't get off of that. Was this the right move or not?
So, by the way, I think all the commentary has been spot on. It's not just a positive that when you cut rates. And by the way, rates were already low, and I would argue they're low enough. There are other initiatives. I think what's important today, they almost got forced into doing it by the markets, and it would have created a problem if they didn't do it. That being said, small business lending programs, putting in place initiatives for transportation, we've got to get more out of the fiscal side. We've got to get more out of the administration. We're going to hear from the ECB. Listen, I don't believe in negative interest rates. I don't think there's any velocity to it, particularly in an aging demographic, where you're actually hurting the banking system, you're hurting the pension system, you're hurting the insurance system, which are your true investors. I hope tomorrow at the ECB or whenever the ECB acts, that you see things that actually get at small business lending. I mean, small businesses are where you're going to have the pain because of supply chain breakage. We need to get those initiatives, and quite frankly, I think the markets did the right thing. It's like, the Fed cut, they sort of had to. Do we really care? We need to see the administration, and we need to see real policy that's fiscally driven.
Interesting. The markets did the right thing. Scott Minerd, do you believe that? Are the markets taking this move by the Fed the right way?
So I think the one thing here that's disturbing, Scott, is we are all becoming way too preoccupied on the micro. That is, the Fed had to cut rates. Should they have cut rates today? Should they have cut them at the next meeting? At the end of the day, all of this stuff is irrelevant. The bottom line is that monetary policy can't really solve this problem, as everyone has pointed out. And we're going back to zero. So let's just acknowledge that rates are going to move a lot lower, and it's time for the policymakers to be sitting down and designing policies like TALF and TARP, where the government stands ready to provide funding to a lot of companies which are going to find themselves cash flow constrained over the coming months.
That's a
Scott, I want to
pretty provocative comment.
Well, if you ask me what the absence, what the missing thing is today, Eamon Javers asked the president yesterday if he thought we needed a stimulus program. The president said no. Right now, they're talking in Congress about some kind of $8 billion program, which I think Mark just kind of laughed at. That's like less than we do in a hurricane. The TARP, as Scott just pointed out, was a $700 billion program and arguably was not necessarily even enough. So that's the missing element right now. The Fed, my opinion, did what it had to do, whether it was forced to do it or not. Maybe the timing was off. It kind of could have waited. If we were 1,000 points down in the Dow now, we might say the Fed should have been out there already.
What was
in
it
any
doing
event,
with fund though? Is that for health care, like emergency? Let's build hospital. Like what? Because we don't have a situation with banks right now.
Bailing out small businesses, I think, is the.
But how do you administer? All right, it sounds great.
I
It sounds great. How do you administer that, though?
Well, administering is difficult, but we do it in floods and hurricanes in the aftermath.
Right.
My policy objective would be those businesses that are good businesses that go out of business because of the temporary disruptions from the coronavirus.
Hotels, travel,
small businesses especially, as I think Mohammed was talking about, and Scott as well. Those to me are the key things that you might do. That's what FEMA does. That's what they do, is they say, you know what? You were adversely affected by this. You have a good business. We're going to put you back in business.
The president has a sort of tight line to toe here, right? They've been maintaining that the economy's in such great fundamental shape that they're not ready to move off that line, it seems, to where, right now you need that could be considered a drastic or dramatic measure.
The president's political constraints are the president's political constraints, not mine.
I'm just saying.
Let me ask you
what I'm saying.
Let me ask you a question. After today, right, I think everybody's watching this show, do you feel better about what happened and now you're ready to go out? Like, am I ready to get on a plane? Am I ready to go to a conference? Has this made me feel better? No. And nobody. And that's what the problem is. You're not dealing with the issue. The issue here is, how do you make people feel better about going out and doing things? And the administration is missing that.
Do you solve that problem by what Scott Minerd said is a massive fiscal stimulus of some kind?
I think that's the monetary aspect. I think what you've got to do is psychologically is to get people to get out, is explain, look, if you're 40 and under, this isn't going to really affect you. Or if you're 50 and under, this doesn't really affect you. It affects people.
I'm glad you moved it up from
I know, so I did that for you.
I totally agree
I'm
with
already
that.
there,
But they're doing the opposite. They're muzzling the scientists.
No, they're
they
not.
think this is a
not.
PR challenge.
They're not muzzling the scientists.
Clearing
They're not.
statements through the White House.
Dr. Fauci has been out a million times. Let's just not go there.
But Marcus, now the moment to get people out. Look, it happens. Things like this happen. Right. There's going to be a period of quarantining, sequestering, whatever you want to call it, cocooning. People are going to reduce it. There are things the administration, I think, could say that would make people feel more comfortable. But getting them out and doing these things is not necessarily one of the things they want to do right now.
Scott Minerd, yesterday we have this 5% move in the market. Did that make you feel like we were in the process of putting in a bottom? Is this what it feels like? You have these big volatile moves. Now you have the Fed injection into the cocktail bowl.
Well, I think, look, we were getting deeply oversold. We knew that somewhere in this 3,000 zip code on the S&P, we should find a temporary support level. But, at this stage of the game, I would say we have more downside risk. And, the expression dead cat bounce, that's what I think it feels like.
Yeah. I don't know, maybe you had a dead cat bounce in yields. Rick Reeder, how low are yields going to go, do you think?
I mean, you certainly could have another 25 to 50 basis points more to go, certainly in the back end of the curve. There's more room here. I mean, if the risk markets come unglued, you can certainly press down rates, and the Fed will get to zero pretty quickly. Listen, I think we're going to be in, I think the way you manage your portfolio today, you've got to keep a moderate risk, and you've got to be thoughtful about, what is the balance in your portfolio. Rates still work in a balanced portfolio, and they could still move lower. My question is, how much risk do you take until you actually get the fiscal initiatives and that are diversified in enough scale to make a difference?
Let's ask the one who's managing people's portfolios. Jim, what are you telling them?
Well, what I'm telling them...
And what are you doing?
All right, so look, yesterday's rally, I didn't think that was the start of a V-shaped recovery, because V-shaped recoveries on market drawdowns like this are extremely rare. So it was highly likely that it was we're going to see a double dip, retest the lows. That's what I'm telling people. And frankly, yesterday and this morning, I've trimmed a little bit further. Scott, I was trimming earlier this year. I'm not going to say that I'm all cash because that's preposterous, but what I'm not doing right now is really buying of any size. I did nibble at United Technologies and Qualcomm because I've had those on my watch list for too long. Bottom line is this: let the double dip happen. Let the retest of the lows happen. That is about 75 to 90% of the time what happens. Whether this is a correction or something worse, you don't go in a V shape. And by the way, that is on the Fed's cut. What my criticism is why don't you wait for the double dip, which is highly likely to happen, and then hit it when people are throwing in the towel. Doing it today after a 5% rise yesterday is just ill-timed.
I think the Fed just wants to be out of the limelight. I think that they want to shift the focus back to the administration and to Congress and say, okay, we're not going to be blamed for whatever might happen over the next 3 to 6 months. We're going to take ourselves out of the limelight, put ourselves on the sidelines. Now, from a fiscal perspective, we need to do that. As it relates to portfolio management, I hear what Jim is saying, but I think that if there are companies in your portfolio that you want to add to in this environment, I think if your view is over the next 3 to 5 years, they could be stronger. I think it's a great time to add to those types of names. And so we're doing that, and we're doing it, I'd say we're doing it thoughtfully, but the high conviction names in our portfolio, we're adding to it this juncture.
So Scott Minerd, why doesn't "don't fight the Fed" work now? I get that the Fed can't make people go to the movies or the mall or get on a plane, but they couldn't necessarily do that in 2008 either, because people had lost a lot of money, yet they cut interest rates in dramatic measures when they had to. And it all comes down to the same thing. No matter what the Fed does, it's don't fight the Fed. Why is this time going to be different?
Well, Scott, it's really interesting here because, the whole formula for the market has been wait for the monetary authorities to come in and bail us out. We're going to make new highs. This is different because this is the equivalent of a Katrina-type disaster, which is national. And it doesn't matter how low you make interest rates. If you're living with a flood, there's not much you're going to be able to do. The interest rates are not going to get people out of their houses and doing things. And it's more than a confidence game. because panic is setting in. This thing is real. And while people will probably be overreacting in the near term, I agree with Mark's comments. The majority of people are not going to die from this thing. But, why take the risk? And that's the view that people are taking. And so, it doesn't matter. We could drop helicopter money on people. They're not going to go out and spend it when they're afraid that they're going to get the coronavirus.
How does the Fed contend with this, Steve? I mean, these are all legit concerns, and you're hearing almost universally from people, whether it's Minard or Lasry, and people who are running billions and billions of dollars, say it's not going to do anything, that it smacks of panic more than anything else.
I think you feel your way. I think every crisis is different, and I think the Fed may not be done yet, either in terms of rate cuts or in terms of the administrative, regulatory, supervisory tools that it could bring to bear against this crisis. I think ultimately you stick to your knitting. I mean, to Jim's comment, I heard, it sounds like a great plan. I don't want the central bank timing the market on what a double dip could potentially be. I think I'll just finish the point, Jim, which is, and give you a chance to respond. You stick to your knitting. You look at what you perceive to be the neutral rate. You find that given what's happened to the rate structure, given what's happened to the term structure, that you have essentially a series of inversions throughout the structure. Look what's happened to stocks. You say financial conditions have tightened. The neutral rate has dropped. I drop my rate to equal that or to be below that. You can have all this fancy stuff about, will it bring people out to the movie theaters or the concerts? And no, it won't, but it will bring down the neutral rate, the Fed's rate, closer to where the neutral rate is.
Two positive things on top of that. The first is that most Americans, maybe not necessarily the viewership of this channel, we all have the benefit of having money to invest. Most Americans, 20% of their monthly budget goes to things like buying gasoline. Clearly, the price of gas plunging is not a negative for those households. The second thing, and take a look at the home building stocks today, they are ripping, even despite higher, despite the fact,
the kind of effect they can have.
Despite the fact that the Dow is not doing as well, industrials are not doing. I'm not saying this will last more than a day or two. They ripped yesterday, they're up again today. It is good for affordability, and we now have the highest cohort of people in this country age 29. That is the biggest age group in America right now. Those are the people that affects, and it's a net positive for them, even if they're worried about recession like everyone else. So it's not all horrible that this is happening. I think monetary policy can play a role, but I totally agree with what Mark said, what Scott said. We need like a big plan for how we're going to get testing done all over the country, and how we're going to give people the right advice. You go to the hospital, do you go to the doctor, do you call this hotline? None of that seems to be happening to the extent that you would hope it is, and I think that is weighing on sentiment as much as whatever the Fed might do next.
And I don't disagree with you in any way, shape, or form in what you said. I think it's playing a role. The key point now, though, Rick, is this just the beginning? Is it just the beginning of a more globalized effort by central banks to get involved in any way that they have? You go back to Draghi of years ago, we'll do whatever it takes. You're going to get a collective message like that, aren't you?
You are. I mean, you're going to get more. You're going to get more out of the Bank of England. You're going to get more out of the ECB. You're going to see more of this come down the pike. Like I say, from a positioning point of view, when you look at whether it's risk assets, whether you look at equities, or you look at credit markets, you need to see the fiscal initiative, and that's the one that'll cause people to jump in. When you get to see really proactive, thoughtful fiscal initiatives, that's why I think. Listen, you manage money for people. We manage a lot of money for people. You've got to take opportunities. We talked about on your show last week, as Josh said, home builders. That business is in structurally great shape. You take some risk in those places. You got to be really careful in some of the others, because we could see more pressure. But by the way, predicting where this virus goes, how deep it goes, how much contagion across the world is pretty darn hard. You don't know where economic conditions are going to be, so you've just got to be proactive around where you're taking the risk.
So, Scott Minard, if you know that Rick Rieder is going to be right and there's going to be this global effort, at what point do you get positive on the market and think that, okay, we overdid it, we were oversold, and it's going to correct itself, and at the end of all this, the economy is